A $3 million traditional IRA is going to get crushed by taxes in retirement, right? This is financial planner Sean Mullaney. Let's discuss. So I'm positing an extreme example, a couple that was incredibly successful financially, but they've got all of it or practically all of it in traditional IRA or traditional IRAs. They're both 75 years old, they're retired, and they got $3 million in a traditional IRA. And if you spend any time on YouTube, Twitter, TikTok, you're going to hear all these personal finance content creators say, wow, what a mistake. $3 million in a traditional IRA. That's going to crush you in retirement. Taxes are going to be overwhelming. Well, we got to run some math, and I'm going to encourage all the accumulators in the audience. You know, ostensibly, this is about a 75-year-old couple, but it's really about someone in their 20s, 30s, or 40s building up their retirement. Stay to the end of the video because I'm going to talk about you guys at the end in a very important way and what this means for you guys. But, let's think about, all right, we got $3 million traditional IRA. Some commentators are saying, well, the IRS owns 30% of that account. One prominent commentator recently said the IRS owns 60 or 70% of that account. I'll link to that below. And so this couple, their $3 million traditional IRA, $150,000 of traditional retirement account withdrawals from that traditional IRA. That's a 5% rate. This couple is saying, well, we know our RMD is a little less than 122,000, but forget that. We're living. Forget you tax nerds. We're just going to live. And yeah, if we pay some taxes, who cares? And we're going to have 40,000 of Social Security, right? So that's 190,000 gross on those two sources. That's almost 16,000 a month gross when we're retired. We're not commuting to work anymore. We don't have a mortgage anymore. We're doing pretty good, but the taxes are going to crush them, right? And I've got some other income here. This couple was not a tax efficient couple, so they've got a little bit of taxable accounts, but the lion's share is in this traditional IRA. So just how bad is the tax hit? I mean, my goodness, $3 million traditional IRA, they're taking more than their RMDs. Don't tell a financial planner that, but okay. They're going to get crushed by income taxes. This is going to be just disgusting, right? Well, let's go down. Let's see what it looks like. I'm estimating that this couple pays $24,300 in federal income tax. That means about $2,000 a month on that almost $16,000 gross. So they're still taking home net of federal income taxes almost $14,000 a month. They're doing fine. Their lived experience is pretty good. They're probably creating trips and vacations in order to get to $14,000 of the monthly spend in retirement. But look at this effective tax rate on adjusted gross income. You would think with the commentators out there, it'd be, 30%, 35%, 25%, some bad number. It's 12.86%. Let's call it 13%. So this is a couple that's very affluent. They built up a $3 million traditional IRA. They didn't take 12% deductions into a 401k to do that, right? No. They took 24% deductions. They deducted contributions into a traditional 401k at 22%, 24%, 32%, 35%. All right, so let's just say it's 24%. So they took deductions at 24%, probably higher, but let's just say 24%. And then they include it back into income at 13%. The IRS won that? Oh, heck no. The taxpayer won that. They used a traditional retirement account and they won. And oh, by the way, a Roth 401k would have avoided a 13% effective tax rate in retirement on a $3 million IRA. And they would have foregone a 24% deduction to avoid a 13% tax. Where does that make sense now, right? Their marginal rate's only 22%. So even on the last dollar, they're still making money because they probably deducted at 24% or 32%, something like that. And look at this. I figured out as a percentage of the traditional IRA balance, the IRS this year took 0.81%, right? I like to joke, if I ever have business partners, I hope you guys are as bad at collecting as the IRS is at collecting traditional retirement accounts. They allegedly own 30% of this account, 40% of this account, 60 or 70% of this account, yet they took less than 1% of the account this year, and the taxpayer's netting a lot more than the IRS does. from this account this year. So I think there's a lot of yelling wolf, right? We're crying wolf, and maybe these taxes aren't so bad. But now you're going to say, well, wait a minute, Sean, there's going to be all these tax hikes. Well, by the way, the recent history suggests the exact opposite. Congress loves to cut taxes for retirees. But say I, Sean Mullaney, am wrong, right? It's happened. Ask my wife. All right. So if I'm wrong and we're going to have some tax hikes in the future, let's stress test this, right? My main contention is that traditional retirement accounts, even one as big as $3 million, are not going to get crushed in retirement. Well, we got to stress test that assertion. Sean, you're assuming that current tax law stays as it is. My guess is it'll get better for retirees. That's a different conversation. But we got to stress test it because, Sean, you could be wrong. Well, all right, let's stress test that. Let's unhide a column here where I make some adjustments to current federal tax law. I increase the capital gains tax from 15% to 25% on the qualified dividends. I reduce the current high standard deduction and go back to the pre-TCJA lower standard deduction and personal exemptions. I increase the 12% bracket to 15%. And then I do something that's just absolutely wild, right? I say, that 22% bracket that this couple finds themselves in? No, Congress, they're going to be reckless. They're going to increase taxes from 22% to 33%. Now, let me tell you something. We're talking about retirement. Congress will get to enjoy an early retirement if they ever dare raise the 22% bracket all the way to 33%. But I wanted to do this to stress test this. Maybe I'm wrong, and maybe in a really bad scenario, this couple will just get crushed by income taxes because of that $3 million traditional IRA. Well, here we go, right? This couple will pay $34,313 in federal income taxes by my estimate. So let's just call it $3,000 a month. Remember, they're grossing almost $16,000 a month. So now they're going to pay $3,000 a month in federal income taxes. That doesn't exactly crush them. Nobody wants to write more, send more money to the IRS, but that ain't crushing them. And look at that effective rate. Even in my tax Armageddon stress test world, this couple pays an effective tax rate on $150,000, right? Plus $40,000 in Social Security, $3 million traditional IRA. Their effective tax rate at 75 years old is 18.16%, right? So they were deducting at, like I said, 22%, 24%, 32%. They are still winning and the IRS is still losing. Yet all we hear from the commentators over and over again is you must switch to Roth 401k contributions now. I can't tell you how often I hear that. So if I'm you and I'm looking, I'm in my 20s, I'm in my 30s, I'm in my 40s. I understand this is just an educational video and there's no guarantees. But under today's rules, traditional retirement account contributions tend to win even if we're somehow able to build up to $3 million in a traditional retirement account. A very unlikely outcome, but hopefully we can, right? Why not? And even if we stress test it and we say, boy, there's going to be all these tax hikes, which never come, even though they're always predicted, but let's just say they finally do come. Well, okay, we pay a higher effective rate, but it's still better than the marginal rate we took those deductions at work. It's still not, and even if it wasn't, even if we deducted at 12%, okay, we come back in at 18.16%, not great, we lost, but we're certainly not going to be crippled in this case, and that's assuming we get up to $3 million, which is not a great assumption. So if you're an accumulator out there, why are you avoiding a traditional 401k contribution? Why are you prioritizing a Roth 401k when you're sacrificing a tax deduction at 22, 24, 32% to avoid a re-inclusion at maybe 13%, right? That's not good tax planning, in my opinion. What do you think, right? Do you think I'm just wrong and these traditional retirement accounts are going to be taxed to death? Or do you think, hey, you know what? Maybe these traditional retirement accounts provide a great way to beat the IRS. Hope you enjoyed this video. If you did, please mash that like button and subscribe to my channel. I'll see you next time.